Okay, we're going to look at that one, P6-34A, and it says, some of J&B's electronics merchandise is gathering dust. It is now December 31st, 2015, and the current replacement cost of the ending merchandise inventory is $30,000 below the business's cost of goods, which was $100,000. Okay. Before any adjustments at the end of the period, the company's cost of goods sold account had a balance of $400,000. And then we need to journalize any required entries. Okay. At what amount should the company report merchandise inventory on the balance sheet? At what amount should the company report cost of goods sold on the income statement? Which accounting principle or concept is most relevant to the situation? Okay, let's see. Journalize any required entries. So it says that it went current replacement cost is $30,000 below the business's cost of the goods. Okay. So do they want us to write off what we're talking about is a write down of the inventory cost, and it might look something like this if I'm thinking correctly. We're writing it down to market value. Let's just make sure we so that might not make sense, right? What did you get?
Not bad.
You did cost of goods sold?
No, I didn't. It was wrong.
It is, it's right. So what we're doing is we're saying because the replacement cost is $30,000 less than what we bought it at, we have to write it down. We're going to write it down to the market value. So this is something we do when the market value of the inventory drops below our cost. Okay. They charged it off the cost of goods sold. So you're actually increasing the cost of goods sold expense, but you're taking your inventory cost down by that reduction. Okay. So at what amount should the company report its merchandise inventory on the balance sheet? Let's see. The original cost was $100,000, and we wrote it down by $30,000. So I would say $70,000, right? 100,000 minus 30,000. Okay. At what amount should the company report cost of goods sold on the income statement? J&B should, okay, so let's see. Did they sell all of it? The company's cost of goods sold account has a balance of $400,000 before this adjustment. So now it's going to have $430,000 because we just added $30,000 more to it. You see that debit? So we'll go $430,000. Okay. Everybody follow that? Okay. Which accounting principle or concept is most relevant to this situation? So we have to think now. Okay. Okay, this is what we call the lower of cost or market. Okay. I would say conservatism. Okay. I think that's going to be the same thing up here. So you want to err on the side that shows your assets, doesn't overstate your assets, right? So what we're doing is we're writing it down by the decrease, writing it down to market. Since the market value is what we could resell it for, or what we could buy it for. If that dips below what we paid for it, then we do that write-off. We write it down.